we on? Okay, sorry. We were singing Broadway classics or from Mary Poppins before, so you caught us in a fun moment. Okay, speaking of fun, we've been talking about receivables, haven't we? Now, you didn't have any homework, did you? Not really, right? To reiterate what we talked about accounts receivables. Accounts receivables are when we sell products or services to customers and they're going to pay us later. We have a receivable on the books, right? Now we know that we have a control accounts receivable and then we have a detail or subsidiary accounts receivable with all the individual customers and what they owe us. And the total of the subsidiary has to equal the control account, which is reflected on the balance sheet, correct? We also talked about there's times that customers don't pay, and we have bad debt expense. I think that's what we discussed at the last part of the previous lecture. Is that correct? Now we're going to talk about how do you account for that bad debt expense. Okay, it's an important lecture. I want to make sure your brains are engaged, okay? I don't think it's hard as long as if you're paying attention, and there's a couple key things that if you hone in on, I think you'll get it. But engage your brain. Now, going to the PowerPoint, this is kind of the organization of the discussion we're going to do today. And sometimes I don't want you to get lost. We're going to talk about some different methods, but I kind of want you to keep in mind where we are in regards to the hierarchy of the discussion, okay? What we're going to say is there's two methods. There's two methods for accounting for bad debt expense. There's the direct method, and then there's the allowance methods, okay? Now, of the allowance methods, there's two categories of allowance methods. There is the percent of sales method, and then there's the accounts receivable methods. And then, in regards to the accounts receivable method, there's two types of accounts receivable methods. So you see what I mean about the hierarchy? Okay? So you might want to keep this in front of you to kind of help you keep your place as far as the discussion today, okay? All right, let's talk about how we deal with this bad debt expense. How we deal with this situation when customers, for whatever reason, don't pay, okay? Now, first of all, we're going to talk about the direct write-off method. This is a very easy method, okay? And let's look at an example. On August 4th, Barton, that's the company that's us, okay? Barton determines it cannot collect $350 from Martin Inc., a credit customer. So the journal entry that we make, now this is the direct write-off method, okay, is we simply debit bad debt expense and we credit accounts receivable for Martin, okay? Now, of course, we know that whenever we debit or credit accounts receivable, we have to go do that to the control account as well as to the individual customer detail, correct? So that the detail in total equals the control account. So we would debit bad debt expense and go reduce this receivable for this individual customer as well as for the control account. Make sense? Okay, now what happens if on September 9th, a little over a month later, guess who wanders in? Martin. And he wants to pay $200 on that account that was written off. Do we tell him you can just take your cash and leave, mister? We wrote your account off. No, we're going to take his money. So what we're going to do is we're going to reduce this first entry. We're going to reverse $200 of the previous entry. So we're going to debit accounts receivable for $200 and reduce bad debt expense for $200. And then we're going to, in this second entry, collect cash, and that would be as normal, debit cash and credit accounts receivable. Okay? Now, some people might say, well, this doesn't make sense. On the same day, you debit accounts receivable Martin for $200 and then credit accounts receivable for Martin for $200. Why don't you just debit cash and credit bad debt expense? Does anybody know the answer to that? Why we do it this way? We do it the way that's showing on the screen because we want there to be a record through the accounts receivable that this occurred. You with me? Okay. So we want there to be a record in that person's accounts receivable that this occurred. Okay? That's not too hard, is it? Now, there's one big problem with the direct method, though. There's one big problem. Let's go back to the entry where we determined it couldn't collect $350 from Martin Inc. What date does this occur on? We make this journal on August 4th. Okay? We make this journal entry to write off the account on August 4th. Let's come off the PowerPoint for a moment. Now, we wrote off that account on August 4th. When do you think that sale occurred? We don't know, but guesstimate.
The month before.
6 months ago.
It was quite a while before. In business, we do not write off an account until we have tried a long time to collect it. Going back to you, Kim, isn't this true? How old were some of the accounts that you were trying to collect?
We normally give them 4 or 5 months.
4 or 5 months? Okay. So what you have here is, let's say this was like 9 months earlier that this sale occurred. So the sale occurred in December, and then the next year, we don't write it off until August, because we've tried for 9 months to collect this thing. Yes?
It's a little off topic, but can you file a lawsuit against that? The company?
Yeah, and you're going to try different things. There's different ways that you can do it.
Yeah.
And, you know, there's a lot of different ways. Sometimes you'll sell it to a collection company or something, but I don't want to go down that road too much. But in this case, just consider this. Let's say the sale occurred in December, and we tried for 9 months to collect it, and finally in August we gave up and wrote it off. Okay? Well, we've got a problem here. The revenue for that sale occurred in December, and the expense related to that in writing it off occurred 9 months later in August. That's a violation of the matching principle. Do you remember the matching principle? The matching principle states that you want to record the expense in the same period as it helped create revenue. You see what I'm saying? You want to match the expense and the revenue to the same period so that when we calculate net income, it makes more sense. So the direct write-off method is a violation of generally accepted accounting principles. Okay? Are you with me? So what do we do? Well, what we do is we have to focus on this matching principle, which requires expenses to be recorded in the same period as the sales they help produce. And we have to use what we call the allowance methods. Let's go ahead and pluralize that, because there's more than one allowance methods. There's different ways we can satisfy the allowance method, I should say. Okay? Now, what we're going to do is at the end of each period, we are going to estimate bad debt expense to be realized from that period's sales. Okay? We're going to estimate the bad debt expense to be realized from that period's sales. And this is going to satisfy the matching principle, because bad debt expense will be recorded in the same period as its related sale. Okay? Plus, accounts receivable will be reported on the balance sheet at the estimated amount of cash that we actually think will be collected, and you'll see that in a little bit. So we're going to learn the allowance method, the different ways we can satisfy the allowance method. Are you with me? Okay. Let's start with the preliminary situation here. At the end of its first year of operations, Barton Company estimates that $3,000 of its accounts receivable will prove uncollectible. Now, the total AR balance at December 31, 2012 is $278,000. Okay? The journal entry we are going to make to estimate bad debt expense is this on your screen right now. We debit bad debt expense for $3,000, and we credit a new account called Allowance for Doubtful Accounts. Or sometimes I call it, I abbreviate it Allowance for DA. Okay? Now, whenever, this is a new account. And for those of you who did flashcards, I always say when we introduce a new account, you might want to add it to your flashcards. Okay? Because I love on tests to ask what type of account it is. What type of account is this? Allowance for doubtful accounts is a contra asset account. Now, we have learned about contra asset accounts before, haven't we? Which one did we learn about that was a contra asset? Okay, yeah, I forgot about that one. Good. We've learned about several contra accounts. Accumulated depreciation was a contra asset. We also learned about sales returns and sales discounts. Those were contra revenue accounts, correct? What does contra mean? Opposite. So let's go back to the screen. If this is an asset is a debit balance account, correct? So a contra asset is, what do you think? A credit balance account. It's a contra asset account. It has a credit balance, and it goes with the other assets on the balance sheet. Now let's look how this will be displayed on, whoops, sorry, went to the wrong one. Let's look to see how this will be displayed on the balance sheet. What you will have is you will have the accounts receivable of $278,000 less that contra asset account of allowance for doubtful accounts of $3,000, and that equals your net accounts receivable, or sometimes people call it the book value of accounts receivable. Does that make sense? It's kind of like if you remember chapter 3, we had the cost of the asset less the accumulated depreciation equaled the book value of the asset. Remember that? Now, I like to ask this on a test, okay? I like to ask, how's this all going to look? Because my theory is always, if you don't know what kind of account it is, or you don't know how it's going to be displayed on the financial statement, you don't really understand what you're doing, okay? So going back to this example, we debit bad debt expense and we credit allowance for doubtful accounts when we estimate that $3,000 will be uncollectible. Okay? Now, we then post that. Now, accounts receivable does not change. We post this to the allowance for doubtful accounts, right? And it's reflected like this on the balance sheet. Now, do you know why we use an allowance account? Why do we use an allowance account? We talked about the need to estimate bad debt expense to satisfy the matching principle. Well, why could you not just estimate bad debt expense and debit bad debt expense, but credit accounts receivable? Why could you not do that?
Well, they could pay. I guess you're giving
Could
yourself
pay.
the
Yeah.
wiggle room.
But here's the real reason you cannot do that, and it's going to harken back to something we discussed earlier. Do you remember when I said every time you debit or credit accounts receivable, you have to do that in the control account, and then you have to go to the customer detail and make that, or make that same entry to somewhere, or else the total of the customer detail is not going to add up to the control account. Do you see, looking at this screen, do you see that if we credited accounts receivable, you can post that to the control account, but where in the subsidiary ledger or the customer detail are you going to post that? Do you see the problem? We're estimating that $3,000 won't be collected, but we don't know who, right? If somebody said, well, you could just put a little bit in everybody's account, well, that would majorly foul up things, wouldn't it? Okay? So we have to, let's keep on the screen and let's look at how this is going to look on the balance sheet. Do you see how by crediting allowance for doubtful accounts, it is a way to reduce net accounts receivable without debiting or crediting accounts receivable, which would require going to customer detail? You tracking with me? That's why we have to use an allowance account. Because we don't know who's not going to pay. We're just estimating that $3,000 is uncollectible. You with me? Questions on that? Any questions? Okay. Now what I want to do is we're going to talk about some different methods here. Now let me come off of, let's go to the Elmo real quick, and I want to stress something. Under the allowance method, when we estimate bad debt expense, the journal entry is a debit to bad debt expense and a credit to allowance for doubtful accounts. That is the entry to estimate bad debt expense. Okay? This is the journal entry to estimate bad debt expense under the allowance methods. Okay? Now, these different things that we're going to talk about now, folks, are just different ways of calculating a number that will go in that blank. You with me? This is always the entry under the allowance method to estimate bad debt expense. But now we're going to learn about, well, what number do you put in that blank? There's some different ways to come up with that number or estimate that number. But this is always the entry. You with me? Okay. Let's learn about the first way. Let's learn about the first way. And the first way is a pretty easy way. And that's going to be the percent of sales method. The percent of, whoops, wrong one. The percent of sales method. Okay? So let's look at this one first. And really these are going to be best learned by doing an example on screen. Okay? Okay, this is a pretty simple method, the percentage of sales method. Bad debt expense is computed as follows. You take the current period sales or the net sales times the bad debt percentage and you get an estimate. Let's look at an example. Barton has credit sales of $1.4 million in 2012. Management estimates that 0.5% of credit sales will eventually prove uncollectible. Okay? All right, this is a percentage of sales method. So we take that 1.4 million of sales times 0.5%, and if you put that in on a calculator, it would be 0.005. Okay? And that equals $7,000, right? Boom. And that is the number. That is the number that goes into the journal entry. And you'll see why I'm emphasizing this so much here in a little while. But the percentage of sales method, you take that percentage times sales, you get a number, and boom, that's the one that goes in that journal entry of debiting bad debt expense and crediting allowance for doubtful accounts. You with me? Any questions on that? Okay, let's come off that for a second. What I want to do is you should have a handout that looks kind of like this, okay? And does everybody still have that I gave you? Handed this out last period. For you folks at home, again, this is on Angel as always. I want you to do example number 1. Do not do example number 2. Just do example number 1 for Mertz Company. Okay? You with me? Let's just roll the music for a minute or so, and let's do example number 1 on this Chapter 9 handout. Okay? Okay, let's take a look at that. Just wanted you to do the first one, okay? All right, Mertz Company had sales of $1.5 million. They utilized the percentage of sales method, which is the one we just learned, for estimating bad debt expense. If they estimate bad debts to be 3% of sales, prepare the journal entry to estimate bad debt expense. Okay, first of all, we know the journal entry is a debit to bad debt expense, correct? And we know that the credit is to allowance for doubtful accounts, correct? Right? Well, we just take the 3% times your sales of what, 1.5 million? And what does that equal? 45,000? And boom, that is the number that goes in the journal entry to estimate bad debt expense. Is that what you got? That's pretty easy, isn't it? Okay? It's pretty easy. All right, any questions on that? Now, let's go back and learn another method. Okay? The next method is the percentage of accounts receivable method. And I think this slide right here is very confusing, okay? I don't like this slide. So let's not focus on it. Let's look at an example. The best way to learn this is to just do an example, okay? So let's do an example. Now here we are talking about a percentage of accounts receivable, okay, method. Barton has $100,000 in accounts receivable, and they have a $900 credit balance in allowance for doubtful accounts on December 31, 2012. Now, past experience suggests that 4% of receivables are uncollectible. Now here, they're not telling you a percentage of sales, they're telling you a percentage of receivables, correct? So here's how we do this. Okay, well, what is 4% of the accounts receivable? It's $4,000. You with me? Now this is not, I repeat, this is not, one more time, this $4,000 amount is not, going back to the PowerPoint, this $4,000 amount is not the amount that goes in the journal entry. It is the amount that we want to be the ending balance of allowance for doubtful accounts. Knowing that we have a $900 beginning balance of allowance for doubtful accounts, and we would like to have this desired $4,000 balance, the journal entry that we have to make is for $3,100. Do you see what I'm saying? The percentage of sale, you just do a calculation and it goes straight to the journal entry. The percent of accounts receivable method, you figure out your desired balance. Okay? That's what we want as our ending balance. Now, what do we have to do to bring a 900 credit balance to a desired ending balance of 4,000? We have to make our journal entry for 3,100. Do you see what I'm saying? Yeah? Right? Okay, now what I want you to do, coming off of that, is I want you to do your second example on that handout. This is the Keatsman Inc. example on that same handout. So let's take a couple minutes and do Keatsman Inc. You at home, do it as well. All right? Let's go. Let's go ahead and do that second example on your handout. Okay? All right. Keatsman utilizes the percentage of accounts receivable method to estimate bad debt expense. Whoops, sorry. Let's start over. Example 2. Keatsman Incorporated utilizes the percentage of accounts receivable method to estimate bad debt expense. If Keatsman has an AR balance of $3.4 million at year end and a credit balance of $6,200 in their allowance for doubtful accounts, prepare the journal entry to estimate bad debt expense if they feel that 2% of AR will be uncollectible. Okay, well, a few things here. Few things. First of all, we know the entry will be a debit to bad debt expense and a credit to allowance for doubtful accounts. What type of account is allowance for doubtful accounts? It's a contra asset with a credit balance this time, right? So here's what we want to do. 2% of AR is uncollectible, okay? So we have 2% times your AR, and AR is what, 3.4 million? What's 2% times 3.4 million? 68,000? Okay. And is that the number that goes in the blank? No, no, no. Got to do a little T account here, don't you? For allowance for doubtful accounts. Now they tell us that allowance for doubtful accounts starts out with a 6,200 credit balance, is that correct? Now this 68,000, that is what we want to be the ending balance, correct? Well, what do you have to do to bring that desired 6,200 credit balance to be a 68,000 balance? What do you have to do to bring that existing $6,200 beginning balance to the desired ending balance of 6,800? You have to credit it for 61,800. And that, my friends, is what goes in the journal entry. Okay? 61,800. 61,800. Do you see the difference? Do you see the difference between the percentage of sales method and the percentage of AR method? I never think this is that confusing, but students really struggle with this. Here's what you have to do. If it's a percentage of sales, the first thing you have to do is see, are they asking, is this a percentage of sales method or a percentage of AR method? If it's a percentage of sale, you figure out the percentage of sales and it goes boom right in there. If it's a percentage of AR method, you have to do this intermediate step, okay? Now, we're going to see, perhaps not in this period, but for sure in the next period, that there are times, well, let me back up. Allowance for doubtful accounts is a contra asset account, correct? Thus, it is a permanent account. It does not close. It does not get zeroed out like revenues, expenses, and other temporary accounts. So this balance we're going to see how this is always going to have a beginning balance. Now, there are times that we'll see next time it could even be a debit balance. And if it's a debit balance, again, then you have to do what you need to do to bring the desired the existing beginning balance to the desired ending balance. You with me? Okay? So here's what I want you to do now. Let's go ahead and work on, in class, I want to do some more practice. Let's do Quick Study 9.3 and Quick Study 9.4. Okay? Not exercise. Quick Study 9.3, Quick Study 9.4. And I think we'll have time to do those and to go over the answer before the class is over. Okay? Quick Study 9.3, Quick Study 9.4. Let's roll that music. All right, if you guys at home aren't quite done, then just pause it and push play when you are done. Let's take a look at this, all right? Okay, Quick Study 9.3. Quick Study 9.3. Wecker Company's year-end unadjusted trial balance shows accounts receivable of $89,000, allowance for doubtful accounts of $500 credit balance, and sales of $270,000. Uncollectible amounts are estimated to be 1.5% of accounts receivable. Now, what is 1.5% of your accounts receivable of $89,000? What does that equal?
1,335.
What is it?
1,335.
1,335. So that is our desired ending balance, is it not? Okay, so let's take a look at the journal entry to estimate bad debt expense. Now, you got to hone in, first of all, on that this is a percentage of accounts receivable method, right? So you have that extra step. It has a $500 beginning balance. You want it to have a desired balance of $1,335, correct? That's your desired ending balance. So what do we have to do in our journal entry? Of course, we know we're going to debit bad debt expense and credit allowance for doubtful accounts, right? We have to make the journal entry for $835. Did you get that? Okay. Now, in the next part of the Quick Study 9.3, it says, what amount would have been used in the year-end adjusting entry if instead the allowance method, come on, Dave, can you talk? What amount would have been used in the year-end adjusting entry if the allowance method had a year-end unadjusted debit balance of $200? You with me? Well, and this could happen, and you'll see more next period why this could have a debit balance. But in that case, we have a beginning balance of $200 on the debit side. We want to have $1,335 on the credit side. So what do we have to do to that account? We have to credit it for $1,535. In a way, you can think of it this way if it's confusing. Let's say you want to have $1,335 in your checking account and you're overdrawn by $200. Well, you've got to put $1,535 in your account to bring it up, right? Does that make sense? So that $1,535 is what goes into that journal entry where you debit bad debt expense and credit allowance for doubtful accounts. Does that make sense? But this is a percentage of AR method. So you have to do these T accounts to get your answer. Right? Now, the next one, is there any questions on Quick Study 9.3? If not, let's look at Quick Study 9.4. Assume the same facts as in Quick Study 9.3, except that Wecker estimates uncollectibles as 1% of sales. Prepare the December 31 year-end adjusting entry for uncollectibles. Well, hopefully they tell us sales. They do. Sales are $270,000. What's 1% of $270,000? It's $2,700. And this is a percentage of sales method. So boom, we don't have to do a T account, right? We don't need to do a T account for Quick Study 9.4. Correct? We can just go straight to the journal entry, correct? No T account is necessary. We just take 1% of sales of $270,000, and this is our adjusting journal entry to estimate bad debt expense under the allowance methods. Did you get that? So the key thing you have to hone in on is it a percentage of AR method or a percentage of sales method under the allowance methods? Okay? Let me point out one thing else, and then I'll give you a homework assignment, and then we're done. Okay? Turn in your textbook to page 363. Turn in your textbook. See at the bottom of page 363, and then going over to page 364 at the top, Now, sometimes people will look at the top of page 364. Students look at that and they go, now wait a minute. This looks totally different than what Dave was teaching us today. We'll turn back to page 363. That's because this is the direct write-off method, okay? And I did teach you that, but we're not going to work a lot on that because that's a violation of GAAP. It's a violation of generally accepted accounting principles. But you might make a note in your book on page 363 and the top of page 364, this is the direct method. This is a violation of GAAP. So that when you're trying to do your homework, you're not looking at the top of page 364. You want to look at the bottom of page 364 and onward. Okay? You with me? Does that make sense? Okay, let me give you your homework. And, this is an important lecture. And if you had trouble with it or you're kind of fuzzy on it, not quite sure where to go, just watch it again, okay? If you liked it the first time, you'll love it the second time, right? Okay, here is your homework. I want you to do problem 9.3a. It's on page 385 in your textbook. And I pretty much want you to do everything except requirement number 2. Don't worry about requirement number 2, but do requirement number 1a, number 1b, number 1c, and number 3. Okay? So problem 9-3a on page 385, do everything except requirement number 2. All right, guys? Nice class period. Okay? Let's see you next time. Make sure you do that homework. Bye-bye.